In a nutshell, cost accounting is the process of analyzing and planning what it costs to produce or supply a product or service. The analysis helps reduce costs and possibly eliminate them. Lower costs, of course, allow for increased profits. Business folks use cost accounting to determine the profitability of a product. The rule is simple: the price should cover the product cost and generate a profit. Competition may dictate the price charged for a product. In other instances, a profit is added to a product cost to create a unique price. In this course, Getting Started with Cost Accounting, we introduce cost accounting and how to compare and contrast cost accounting with other accounting methods. Also, we explain how cost accounting can help you improve your business, such as by using pricing, budgeting, and other tools that can help you become more profitable. Accounting is the process of recording, reporting, and analyzing business transactions. It's the written record of a business. Cost accounting is the process of capturing all of the costs of production, whether a business manufactures a product, delivers services, or sells retail items. Cost accounting is used for all types of businesses. Often, cost accounting overlaps with other types of accounting, such as financial accounting and management accounting. If you have some knowledge about these other areas of accounting, that background can help you understand cost accounting. If not, no big deal. This course helps clarify what cost accounting is, how it's used, and how these accounting methods relate. Financial accounting is a reporting process. An accountant reports on the financial position of a firm and the firm's performance by creating financial statements. The statements are used by external parties to show how the company is doing. External parties include shareholders, creditors, and regulators. The external parties may not have an accounting background, so there are many rules of the road, and they are very specific for creating financial statements. The rules exist so that each set of financial statements is standardized. If all companies follow the same set of rules to create financial statements, the information is usually comparable. Financial accounting looks backward. It's retrospective. The accountant is creating financial statements for transactions that have already happened. So unlike cost accounting, financial accounting doesn't provide any planning or forecasting. Your external users want financial statements on a periodic basis. Companies typically issue financial statements on a monthly, quarterly, or annual basis. External users want to know how you're doing for a variety of reasons. Cost accounting runs through your entire business process. To begin, you decide whether the cost of obtaining the information is worth the benefit you receive from it. If you decide that it is, you use cost accounting to analyze your costs, make decisions, and look for cost reductions in your business. The cost of obtaining information should be lower than the benefit you receive from your analysis. The cost includes labor hours and technology costs. For example, you need someone to search for the information. You also may need to create new cost reports in using your technology. The benefit of performing the analysis is the cost savings you're able to implement. Say you manufacture dining room tables, you make 5 different models of tables. At one point in production, your staff sands the wooden tabletops by hand. Until now, you haven't calculated the time required to sand each type of table. You take the total labor costs for sanding and trace them to each table, regardless of the model. Maybe you should do a cost analysis and assign the sanding cost to each table model. You incur some costs to do the analysis. Someone on your staff will go through the employee time cards used for payroll. The workers record the time they spend on all tasks, including sanding. They also record the table models they worked on during production. Your accountant can compute the total sanding time per table model based on the time cards. Consider what you might gain. You assign the sanding cost more precisely. As a result, each table model's total cost is more accurate. Because your profit is the sale price less than the total costs, the updated cost allows you to calculate a more precise profit. Sounds like the cost of the analysis might be worth it, especially if the competition is high in your furniture-making industry. Cost accounting plays a role in your budgeting process. You might think of budgeting as just forecasting sales and planning expenses. If you own a flower shop, you budget by forecasting sales of each type of flower arrangement. You also plan expenses, such as utility costs for the shop and your lease payment. Your work with cost accounting takes budgeting to a new level of detail. Until now, you looked at costs by type, utilities, lease expense. Now, you analyze cost by type and by product. For example, those roses need to be kept in a cooler, which requires electricity. Based on the product's costs and sale price, you can compute a profit. So, start off with an analysis of each product's cost, price, and profit. Build on that information. You could then put together a budget for each department. Finish up by combining all of your smaller budgets into a company-wide budget. That company-wide budget will give you all of the company's costs by type and your revenue total. You build your company-wide budget based on cost accounting by product. By starting your budget at the product level, your budget is a lot more specific. When you compare your actual results to your budget, you'll see the differences in more detail. The detail lets you make more precise changes in your business going forward. Cost accounting helps you stay on top of your costs and make changes along the way. You should analyze costs frequently. Most companies perform this analysis on at least a monthly basis and sometimes weekly or even daily. The more specific you make your analysis, the better. As always, the benefits you gain from your analysis should outweigh the costs. If you analyze costs frequently, you find areas where you can reduce costs immediately. There's nothing worse than discovering a problem after it's too late to fix, so don't create a budget and shove it in a drawer. Review your actual results and compare those results to your budget. If you find large differences, dig deeper. Consider reviewing more detail to find out what caused the difference. Here are some tools you can use to control costs. Number 1. Cost Volume Profit (CVP) Analysis. CVP is a simple tool to analyze costs, sale price, and units sold. There's a user-friendly formula, the kind of tool you can play around with on a notepad or spreadsheet. Number 2. Variance Analysis. Variance is the difference between your planned costs and actual costs. A large variance is a red flag, a number that gets your attention. You investigate variances to find ways to reduce your costs. Number 3. Activity-Based Costing (ABC). This analysis allows you to assign costs using the activities put into making your product or service. ABC assigns costs to products based on levels of activity. Labor hours incurred, machine hours used, and so forth. Number 4. Support Costs. Nearly every business incurs support costs. These are areas of your business that support your production and sales efforts. Accounting and legal costs are good examples of support costs. Number 5. Joint Costing. Your business may use the same process to produce several different products. This situation is called joint production. The products will share the common costs of this production or joint costs. After you've nailed down your product's full cost, both fixed and variable, you can price your product effectively. The difference between your price and full product cost is your profit. Consider how pricing comes into play. Your product's price may be limited based on competition. Your profit is sale price less cost. The only way to increase your profit is to lower your costs. Assume that you make a product that's unique. You don't have many competitors. As a result, customers are willing to pay more because they can't get the same product somewhere else. To meet your profit goal, you start at the bottom and work your way up. You compute your full costs first. Then you calculate a sale price based on your profit goal. You have the ability to push the price higher because you believe that customers are willing to pay a higher price. When you change the costs assigned, you can consider changing the product's price. That's because a change in the product's cost changes the level of profit. If you face heavy competition, a higher price may hurt your sales. The other choice is to find ways to lower other costs. Keep in mind that pricing your product isn't a one-time event. As you analyze costs, you may need to adjust prices more than once during the year. Successful businesses constantly make improvements. This approach is the only way companies can survive and thrive over the long term. That's because competitors eventually take business away from you if you're not willing to change. One type of improvement is analyzing your business to lower costs. You can lower your costs in several ways. Maybe you remove an activity that isn't necessary. When you eliminate the activity, you get rid of the related costs. Here are some other possible improvements. Number 1. Using the accrual method of accounting. You decide to use the accrual method of accounting. This method matches your revenue with the expenses you incur to generate the revenue. Using this method, rather than the cash basis of accounting, gives you a more realistic picture of your profitability. That a better view helps you make more informed decisions. Number 2. Deciding on relevance. Make a judgment about what you believe to be relevant. Relevant means important enough to consider in a decision. Your threshold for considering relevance might be expressed as a dollar amount. When you decide what amount or percentage is relevant, you use it as a filter for decision making. Anything over the threshold needs to be analyzed and considered in your decision-making. Number 3. Demanding quality. Demand is a strong word, but it should be applied to quality. You will not succeed as a business without a constant focus on quality. It's simply too easy for customers to use technology to find the product or service somewhere else. Quality means more than making a product or service that the client wants. The term also means fixing your product if it doesn't work. Finally, quality means asking customers what changes they want in your product or what new products they would like to see. Ask your customers and they'll gladly tell you.